So good day, everyone. My name is Barbara Riccardi. I am the regional head of Natixis CIB in the Middle East. And I am delighted to be hosting here today one of the panels that will be animating the 9th edition of Natixis Infraday, who also happens to be the first Infraday that will be held virtually. So I would like to start by welcoming our esteemed panelists who were very kind in accepting to be here with me today and discuss Middle East infrastructure and key trends. So I will start the introduction by looking at the order of my screen. So on the left, I see Paddy, Paddy Padmanathan, President and CEO of ACWA Power. Paddy is a seasoned engineer and energy expert with over 40 years of experience. He's a key member of ACWA Power executive leadership, and prior to that, Paddy was Vice President and Corporate Officer at Power, Water and Wastewater Project at over a dozen countries. So welcome, Paddy. Then I see, good morning, good afternoon actually. Then I see Bruce. Hi Bruce. Bruce Johnson recently moved to Masdar, where he's now heading structure finance, treasury and insurance. He was previously a Mubadala since 2014, and he has over 15 years experience, including in Natixis in London and KPMG. And last but not least, Andrew. Hi Andrew Paulson. He's a principal for Global Infrastructure Partners. He has been there for 2 years, and prior to that, he had a long stint at RBS, where he was heading the infrastructure team. So thank you once again to all of you to be here. I think we can start with the obvious topic that probably everybody would address, which is COVID. How did COVID impact our region? So what we saw on one end, fiscal deficits having massively deteriorated with very heavy borrowings from all the governments and a wave of sovereign bond being issued. We also saw oil price collapse that obviously further pushed up the debt over GDP. But then on the other end, we kept seeing infrastructure needs increasing. And this was obviously the result of the need for more digital connectivity, robust utility infrastructure, good healthcare, and resilient transportation services. So it's therefore fair to say that infrastructure is expected to have an important role to play in the recovery from this global crisis. And at the same time, it is expected that they will support the transition towards sustainable growth. And this can be achieved through innovation, really, throughout technology, from technology technical standpoint and from a financing standpoint. So how do you believe you and your companies are placed in delivering this? And maybe Paddy, since I see you in front on the screen, please, if it's okay for you to take this one.
Thank you. No, my pleasure and privilege. Thank you for including me and inviting me to participate. Look, on the one hand, it's a terrible tragedy, a hugely challenging environment. But on the other hand, it has presented us with a huge amount of opportunity. Infrastructure is desperately needed in this part of the world anyway because of all the other social and economic growth that is driving it. So it's not something that we are kind of having to come in and do in order to stimulate the economic development. And so already we were on a track to do a lot of investments, and now the need is even that much more. What we are seeing is that largely supported by technology, technological innovation is belting away at a pace that is giving us spectacular chances to deliver infrastructure and services at a lower and a lower cost, therefore increasing levels of affordability. And what we are seeing is that in a world of negative interest rate sort of environment, where there is a flight to quality, so long as these are well-structured, asset-backed projects, we are finding the liquidity. For sure, I'm sure we'll get into it a little bit more in detail, but we are looking to broaden the pools of liquidity, but definitely we are seeing a rapid growth. In the last 5 years, in the last 5 months, we have ourselves brought so many projects to financial close right the way through this COVID period.
Absolutely, and actually building up on what you said on the liquidity and on the different source of financing. Maybe we've seen Abu Dhabi being instrumental when encouraging and implementing different solution, that capital market solution for all those funding infrastructure needs. And this is this is now gone to the next step. And what we saw as an institution who has been very active in the region and has witnessed more and more institutional investors are participating to financing and also on the equity side. So we're really hopeful that that we can see that replicate for other regional players. So the question is, first of all, do you see other players such as Saudi as potentially replicating this model? And also, while we understand that this model is helping in terms of tariff, it's making it more competitive, it is also true that it's pushing a lot of the refinancing risk back into government hands. But is that really a bad thing? And maybe, Bruce, if you don't mind taking this one.
Yeah, sure. Thanks, Barbara. And like Paddy said, also very pleased to have been invited to talk today. I think, from my perspective, I am completely fine with refinancing risk being taken off the table. The impression that I have is that developers like Masdar and ACWA, along with the very demanding technical criteria, which is being demanded by procurers and banks, means that we are developing exceptionally high quality projects which are built to last. I think what that effectively means is that assuming normal market conditions, such projects are going to be attractive to both banks and equally DCM investors in the context of a refinancing. But I think the reality is that projects, whether it's Masdar or an ACWA project, they will always attract somewhat similar refinancing terms. So I think when it comes to bidding for projects, having a competitive edge really comes down to how much of your equity return you want to hang on achieving certain refinancing terms, which you really have little to no control over. So when you look through that lens, I think taking refi risk out of the developer's equation means that tariffs are more heavily made up of constituent parts which are within developers' control. It also means that the winning bidder is not the bidder who is simply taking the biggest risk on refinancing. The winning bidder is more likely to be the bidder who can come up with the most innovative technical solution, and I think that's a good thing. What it also does is it opens up the door, more so than before, to DCM solutions, which again I think is a good thing. I think bankers like yourself will have a better view, but my own is that there cannot be an inexhaustible supply of cheap bank debt to finance every greenfield project and refinance every brownfield project, particularly with the scale and growth of the infrastructure development in this region, including Saudi. Banks have country limits for good reasons, and I imagine there may come a tipping point when it becomes necessary to recycle bank debt into the debt capital markets. And naturally, I think it makes sense that this happens in respect of refinancings because banks are still the best placed counterparties to finance projects during their construction phase.
Absolutely, and I think we had an obvious example of that. I think on when talking back on the liquidity and also on liquidity aimed at a takeout in a bond market. And if I may, I will actually ask that question very shortly to Andrew. But you have recently closed, Andrew, probably one of the largest transactions, certainly It was quite impressive to see that closing pretty much in COVID time, with a multi-billion of liquidity being attracted to your Galaxy financing. So it would be interesting to hear. It obviously seemed to having been done very well and very easily, but I'm sure that there have been challenges there. So if you could share with us what challenges really you faced, what were the biggest ones you faced, and how did Galaxy compare with other experience with similar deals that you have done?
Well, Barbara, I'm pleased the transaction looked easy from the outside. It didn't always feel as such on the inside. Look, thank you for your introduction, and just to sort of introduce myself, I look after the finance and capital markets activity for GIP. So one of the important transactions for us, as you say, was the $8 billion acquisition financing that we put together for Project Galaxy. I was, good to hear Paddy's comments. Actually, I'd echo a lot of those. I mean, it's been an interesting period through COVID. We launched the process for Project Galaxy on the debt financing on Monday, the 30th of March. And that's, I think Monday, the 23rd of March, I know the markets tend to sort of refer to as the COVID trough. But it was with a little bit of trepidation coming into this market that we went out to raise the $8 billion. Maybe just to sort of give a little bit of colour to you and the broader participants. What we found as we came out into the market was that a number of the banks that had been supporting us earlier in the process were no longer able to participate. So we had, we had a different shape of a bank group emerging quickly, and those that were still keen to participate and were motivated. There were two observations I'd make. The first really was that many banks seemed to be in the process of discovering their own institutional appetite through COVID, and we were sort of living through that in real time. And secondly, and it was very stark, was really banks' own internal cost of capital was clearly very divergent. I mean, typically, I do this kind of stuff quite a bit, and Paddy and Bruce will also be very familiar with it. Typically a AA rated type transaction, you go out to your banks and the pricing and the terms that you get back is in a pretty narrow margin. What I mean by that is, you can call the deal 5-10 basis points kind of either side. I mean, the pricing we got back was just all over the place, and was really, quite something, but I think was indicative of the fact that we were launching a transaction into a difficult period of the market. And whilst now, as we look back at that period in time, to Paddy's point, we've seen 5 months of very constructive markets. It certainly wasn't the case. I mean, the DCM market was closed at that point in time for GCC issuers, and I think that was a big factor driving, where banks saw the transaction. So it was a challenge getting the liquidity together. I would say, Adele and the team that led this, and by the way, let me take the opportunity to thank Natixis for your support through the transaction, because it was very important for us. We approached the deal in quite a different way to how we would ordinarily approach a transaction of this nature. Reminds me of the deals of sort of 2008-9 at that point in time, where really you're trying to nurture a bank group together. You're drawing heavily on your relationships. You're really trying to understand where banks are and trying to work with them actually to make sure that they can present the story internally. Obviously, a lot of banks were very concerned that the deal wouldn't get done, or they'd be hit for a bigger target size than maybe they'd want to hold. We were working with 22 banks. We worked with them all bilaterally and independently. The final bank group was 17 banks, and I think through that process of nurturing and working, it was interestingly, as you say, I mean, the subscription level was $13.95 billion. So what does that say to me? I mean, it says to me just how strong fundamentally well-structured deals, well put together with a strong sponsor group and a terrific partner as we have in ADNOC, that flight to quality that you've been mentioning actually comes through into these sorts of transactions. And actually it became clear to me as we went through that really, for banks that were still active and looking to participate, this was exactly the kind of deal actually that you want to be involved in. A strong credit, strong sponsor group, well structured, well put together. For that we were delighted with the outcome. But it wasn't plain sailing, Barbara. I had a few sleepless nights on the way through, but delighted that we got there.
Absolutely. No, I suppose, everybody was very impressed, for sure, that it was done despite the COVID time. And as you say, the liquidity amount for the right transaction was really obvious there. So, and then just don't want to grill you, but just since we are on this, on the Galaxy financing, and since you are a global investors and you've seen multiple bridge to bond structure, do you think that this solution is something that should be considered for large financing only? Is more suited for that, or is it something that can be applied more generally? Is it the norm for you?
Look, we look at different acquisition financing structures. I would say the norm for us is the bridge to bond structure. I mean, I know one of the many enjoyable things about our role is everybody has a different definition of bridge to bond. We think of a bridge to bond as a 5-year acquisition financing. Many of our banking partners, particularly our investment banking partners, seem to have a shorter term view of that. And the reason we like the bridge to bond structure in most of our portfolio is that we, really from a GIP perspective, what we're looking to do is to acquire a business and then really focus on the operational transformation of that business. So we like that time where, we know we haven't, our new management team aren't worrying about the financing. They're just focusing 100% in the first couple of years of our ownership, on driving through change. And that's typically the point at which we then approach the capital markets. But this investment is different, and it looks a lot more like our renewables investments. About 42% of our capital is deployed into the renewables sector. And of course, here you've got, you've got rather than a perpetual asset, you've got a concession asset. Typically, Bruce, I think, made the point very articulately that, refinancing risk is absolutely critical. So you've got to form a very clear view on your takeout strategy, even before you approach the banks, and, be very clear on what you're seeking to achieve. We, in a case like this, and given the strength of this investment, the underlying business, the strength of the AA DCM market that we see for the takeout, the strength of our partner in ADNOC, we were able to get ourselves comfortable with with the refinancing risk, which Bruce says is absolutely kind of material and fundamental to the investment decision. I'd also question whether for a transaction of an $8 billion size, it's very difficult to see a bank market, a competitive bank market backdrop for a deal of that, of that size on a 20-year tenor. So look, it's something we're very comfortable with. You can imagine our investment committee process. We spent much time on the refinancing, and we'll see if we've got it right.
It seems like you've done quite well so far. So, and you touched upon acquisition finance, and maybe Paddy, if I may, we know that you have been very active on brownfield acquisitions, which is obviously a very interesting space that has potentially a huge amount of activities backing it. Is this ACWA strategy going forward?
Look, our strategy is pretty straightforwardly wherever we can add value. We are not going to sit and wait for brownfield. I mean, there's a huge pipeline of greenfield that's ahead of us. So, quite frankly, that'll remain inevitably our focus. Having said that, you're right. I think it's public knowledge that the Kingdom of Saudi Arabia is very focused, and it's going to start now systematically implementing significant privatization sort of processes, particularly with both the generation assets owned by Saudi Electric as well as the desalination assets owned by Ceylon Water Conversion Company. So these are massive portfolios, and there'll be oodles of opportunity. I think we will continue to be, people see us very active, so people think that we kind of do everything. Well, no, I see so much in front of me. So we say a lot of no's. People don't realize that. So we will continue to be very selective. So we will participate where we think we can add value. We are not interested in a market share. We're not looking for megawatts or cubic meters, sort of tick the box. No. It's very much where we can add value and make a profit. And we're not a financial investor. We're a very active, so take something, improve it. Then if we see the opportunity, then yes. The other thing that I think we are going to be very careful about going forward, and all of us, I'm sure, will be, is about making sure that we recognize the need to decarbonize. It's not about the flavor of the month ESG. It's starting to become like that, but forget about that. But I think we all recognize the basic need to decarbonize as much of human endeavor as possible. So our focus is very much towards that. We've jumped right into green hydrogen, for example, on the back of low-cost renewable energy, because hydrogen is another route to decarbonize some of the hard-to-abate stuff. So for us, that's much, much more exciting. And I'm not going to say we're not going to do green brownfield. We will selectively do it where we think we can add value.
Thanks. And actually, you helped me very much, because it's a perfect transition to the next question that I wanted to ask, and Bruce in particular. Indeed, you said the need. You pointed attention to the need of decarbonizing on pushing green and sustainable type of developments. So we've seen the region making very ambitious announcement in terms of delivering specific targets on renewable, and then more generally power, water. How much do you think, how much challenge there is in the region to actually be able to deliver on those targets? And this is Bruce, actually, yes.
Yeah, thanks, Barbara. When you sent the question through, I think the way I thought of it was, probably the biggest challenge is actually educating people, and that if you can educate people, actually everything else just naturally follows from that. It kind of amazes me when I'm reading various news channels online, and I won't kind of tell people which ones I tend to read, but it amazes me some of what I would describe as kind of backward thinking by incredibly influential people on the global stage. Right, and so in order to really realize the full potential of green investment, I think we need to kind of continuously shape the mindsets of all the various stakeholders. So, as an example, it's an absolute myth that you give up returns when you invest sustainably, right? I think the reality is that returns are comparable. I think in some cases even superior to conventional investments. The pendulum has swung in recent years such that renewable technology can actually generate power more sustainably and more cheaply than conventional sources of power. And to be perfectly frank, I'm not sure that really has sunk in, but it's been the case for years. I'm not sure whether that's the media kind of not kind of really grasping the concept and relaying it to the masses, or whether it's a case of like people like us not really kind of shouting loudly enough about what kind of returns renewables can generate, and you know what, and that they can be generated like much more cheaply than other sources. I mean, I think you are starting to see that revolution, if you like, in terms of people being educated happen. I read a statistic that the younger generation has sort of embraced the theme of sustainability, and so you'll see, you know, 56%, I think it was, of people between the age of 18 and 34 in the UK would prefer to see their pension funds being invested in green investment vehicles. So, you know, I think with people like us talking continuously, perhaps ad nauseum, about what a great thing it is to be investing in renewables, and I think with, you know, our companies beginning to report on their social and environmental contributions, I think it will begin to make a difference. But I think the challenge is really just to kind of just do more of it, right? And just to continually educate people. And then once you've kind of gotten over the hurdle of educating people, I think everything, like I said, will naturally follow. Even when you do have certain people making noises, which, like I said, I would describe as like pretty backward, to be perfectly honest with you. I mean, you still hear, I think maybe it's the media, but you hear about there being a rise in the number of people who believe that the Earth is flat, and like, you know, it's that sort of thing is absolutely staggering to me, right? But I think, you know, those people are obviously in the minority, and I think increasingly you will find the people who detract or say negative things about the renewable industry will increasingly become in the minority as well.
Fully on board, absolutely. And I hope I never have to meet any of those guys trying to claim the Earth is flat, because I have some issues in pretending to be serious. But yes, and then maybe Andrew, since, you know, I think obviously Paddy spoke about the renewable and sustainability, so did Bruce, and how important it is for you, for GIP, when looking at green and sustainable type of financing, or more generally, investments?
Well, I mean, it's right at the heart of what we're doing, and you know, it's enormously important in our investment decision-making process. It's enormously important to our own LPs, and it's important from the financing side. And I think, you know, I think I mentioned earlier on in the call, you know, we have, you know, a significant portion of our investment portfolios in the renewables space, so that's sort of quite straightforward from a financing perspective. But I'm sort of pleased you raised the point, and if you don't mind just sort of digressing from energy for a moment into transportation, where we've been very active in green financing. And you know, without taking the wind out of the sails of my colleague on your rail panel today, but one of the things we've done in our high-speed rail business, which is called Italo, it's one of the world's most sustainable, environmentally friendly, electrically powered passenger high-speed rail services. What we've been very focused on there is making sure that we are aligning our incentives and our commitments as an owner with our banks and our lenders. And the way we've done that is that we've structured our bank financing. It's a 1.3 billion euro financing with the margin linked to our performance as owners of that business, meeting ESG criteria that we've agreed with our lender group. So if we deliver on our promises and the direction of travel that we want to take the business in, the margin on our term loan reduces. And conversely, if we don't, the margin increases. And this is a sort of, I think, quite a pioneering approach, which is something we want to be doing a lot more of, so that we're really getting that buy-in that Bruce talks about, so that it's not just that it's important to us as a firm, but it's important to our lenders and to the banks that we want to work with and who want to work with us. And we've taken that a step further, in that business as well, where we've linked the credit spreads in our interest rate swaps to the beating of our sustainability, our ESG objectives. As Natixis, you've been very much a part of that, and we thank you for that. But I think it's actually incumbent on the likes of ourselves as major investors to be really leading the way in many of these aspects. And I think it's really very exciting because to me and to GIP, this is how we're really going to drive change on such an important agenda, is to make it absolutely central to our investment and our financing strategy.
Thanks, Andrew. That's really, really interesting. And if you allow me, I just going a little bit off script here, and this is just an open question, but do you think that in the future, whether midterm or long term, we might see more investors that would normally not be here in the Middle East, but would consider the investment because of its green and sustainability angle? And I don't know, Paddy, Bruce, Andrew, just feel free to.
Yeah, thank you. Look, I think, thank you very much to Natixis. We are working with you on several things, and that's exactly the point that we are finding. Definitely, I think there is a greater recognition of the commitment of the region to move towards a green economy, reconfigure energy systems and so on. I think people have really understood it, and the region is able to offer some very large transactions. So it's the combination of now the real focus on the region and the scope and size of these transactions. That's really what is attracting new pools of capital. And Natixis has done a fantastic job in starting to bring some of those, typically like the insurance investors out of Korea, trying to package these products in the right way. And touching also on the thing around, so with all these new stuff, what is the biggest challenge? Well, for us, what we are seeing as the biggest challenge is not the opportunity, obviously, it's there. Technology is being delivered at a fantastic pace. We are able to deliver solutions. Capacity will continue to grow in terms of construction capacity and so on and so forth. The piece that I think will become more and more challenging is the human resource capacity. These are all fairly big projects. They need more and more people to manage them, manage the risks. So constraint to growth, we have always found from the day we were founded, is people. Well, we've been lucky. We've been able to attract and retain and grow. But as projects become bigger, more and more come online, it's very much more challenging.
Well noted. Yeah, thank you, Paddy. And maybe just mindful of the time, I think we have 10 more minutes. Bruce, touching back upon what you said on power and renewable. What are the main trends that you foresee in terms of power and renewable innovation?
You know what, Barbara? This is kind of a difficult question for someone like me who sits in the basement at Masdar Towers, right? In the finance team. I'm not really kind of on the forefront of our business development activities. What I do is essentially kind of take those projects which are presented to me, and then I help the team who are leading it to arrange the best possible financing, right? And I go out and I beat up banks like Natixis and so on, right? And that's what I have to do, right? Because at the end of the year, like, my performance review is based on the feedback I get from my internal clients.
Absolutely.
But having said all that, there's a couple of innovations which I've seen come across my desk recently. The first one worth mentioning is we have a project in the UK called Highwind with a Y. It's the world's first commercial scale floating offshore wind farm, which we co-developed with Equinor. It's located in Scotland, which is where I'm from, so it's close to my heart. And floating offshore wind is a subsector which I anticipate seeing much more of in future as the technology becomes more seasoned. Closely related to that, we also have what's called the BatWinds project, which is essentially a pilot utility scale battery project which uses the excess electricity generated by the Highwind project. So it's onshore at Peterhead in Scotland. It employs algorithms which control the, and by the way, like I'm going to start to sound like I know what I'm talking about, but I really don't. But it employs algorithms which control the storage and release of electricity, with the aim being to increase the economic value of the battery. And the algorithms rely on multiple, data sources, including weather forecasts and market prices, maintenance schedules, consumption patterns, and grid services. And what it does is those algorithms essentially teach the battery. I think of a better way to describe it, but battery is taught best way to stack the different operational modes together so that the utility and revenue of the battery is maximized. So yeah, I mean, I think we'll tend to see more of that in future. The Highwind project, I anticipate that we will actually take it to market for our non-recourse financing in late 2020, early 2021. And that will be a good precedent to set for that subsector. Likewise, I anticipate that we'll be doing more battery storage projects in future. Masdar recently acquired a 50% stake in EDF Renewables US renewables portfolio, and a number of those projects within the portfolio will have battery technology attached to them. And there's also a financing happening there. So, I think we're going to start to build a pretty decent track record in terms of financing on a non-recourse basis some of these, somewhat nascent subsectors. And then, like is the case with offshore wind today, I think in 5 years' time, it will be a pretty well banked. Those will be pretty well banked technologies.
Well, Bruce, not to be technical, I think you nailed it very well, and I saw also Paddy being the engineering in the room nodding. So well
Great.
done, indeed.
Excellent.
You've done very well.
A+.
A+ from all of us. Yeah. So just to conclude on the last question, and I guess you all have experienced the international debt capital market to fund your infrastructure project in the region and more globally. And it'll be interesting to hear more about what type of investors you see being active and what type of capital market debt you expect for infrastructure projects in this region. And I know either Paddy or Andrew, I see both of your faces coming up on my screen, so please feel free.
Happy to quickly jump in first and then leave it to Andrew. So look, we're very pleasantly surprised 3.5 years ago when we stepped in by bundling a pile of operating assets in Saudi Arabia, and on the back of that, we raised and we got it. It was a project finance package, very unusual, a portfolio, but we did manage to bundle it in a way and structure it right to get it credit rated with investment grade, and went into and issued a Reg 144 Reg S bond and sukuk on the international market, registered in Ireland, and we were very pleasantly surprised how well it was received. What a very wide distribution we had from the US as well as the Far East as well as the region. We were well oversubscribed. Pricing was tight. So what that shows us is that, look, what investors, and it's a huge broad base of investors out there, whether they are funds, whether they are insurance companies. We saw in our portfolio now, we have insurance companies, and infrastructure funds and hedge funds, all sorts of people in there. But what they're looking for, clearly quality, clean a structure that is supported by solid legislative sort of framework, and transparency, as transparent as you can be, so that they can look right the way through into virtually every day of your operation. And there's a huge amount of attraction throughout the region for these kind of assets in this part of the world. No issue.
Yeah, look, I'd echo that. I mean, it's been, it has been interesting. From my perspective, I mean, we've not yet issued into the long-dated capital markets, with Project Galaxy. But what I would say is that it's the natural home for the asset, matching the asset life with the liability of the liability outlook of many of the big insurers and the global capital markets. I'm very hopeful. As you'd expect, I'm following the GCC DCM markets very closely at the moment. I mean, it's really striking. Just how well received these transactions are and how much interest and appetite there is. I would say as well, since we announced the acquisition in July, we've had a lot of inbound interest from debt financing investors globally who'd like to look at the transaction. We're regular issues in USD 144A Reg S. We're very active in the 4A2 institutional market. Our portfolio companies issue into sterling, euro, samurai format, Aussie dollar format. So we see quite a few markets, and many of the players in those markets who are established DCM relationships with us are sort of coming to us, and are so clearly excited at the prospect of the region. I think I'd agree with Paddy. I well-structured deal is key. The other thing that I would add, which I've long since felt both as an advisor and now in this role, is that really telling the story, getting the story clear and articulating that into the bond markets is critical, because as we all understand, actually your contact time with the investor community through the marketing phase isn't a long one. So you've really got to get that story tight and clean, as you say. So we're very much looking forward to in due course accessing the GCC bond markets.
Excellent. Well, I guess, Bruce, I don't know if you wish to add something to it.
Yeah, Barbara, not much to add, so to be honest with you. In my kind of sort of role advising Masdar over the years, the only DCM issuance that I'm aware that we've done was the Dudgeon offshore wind refinancing. So it's not related to the region. We did, however, get a public rating from Fitch of A-, which was I think remains the strongest rating for any offshore wind financing to date. And yeah, I think that was the first and only kind of capital markets issuance for Masdar financing. But we certainly have projects, including some in the region, which are ripe for the inclusion of some sort of DCM angle, which you guys are pretty familiar with some of those projects. And yeah, I hope in due course to be involved and hopefully executing one of those refinancings in the debt capital markets.
Thank you very much. Well, gentlemen, thank you all very, very much. I think our time is up. It's been really a pleasure, a very interesting discussion. I really appreciate your input, and thanks also for allowing me to go off the script here and there. And it's been really very good to talk to you all. So best of luck in all of the projects you're involved in, and we hope to continue working together as tightly as we have been doing in the past. And again, thanks a lot. Thanks a lot.
Thank you. Thank you for including us.
Pleasure.
Great.
Bye, Paddy. Bye, Cruz. Bye, Andrew.
Bye.
Bye. Thank you so much.
Bye.
Cheers,
Bye.
Bye.